be learning about cash flow management with a twist, the 7 C's, and the path to financial stability, security, and success. This webinar series is in partnership with San Bernardino County and Mr. Eddy Sumar, who is our Director of Education for the Inland Empire Regional Chamber of Commerce. So I thank you all for being here, and I'm going to go ahead and turn it over to Eddy to begin the presentation.
Good morning to all. Thank you, Mr. Ornelas, and thank you to IERCC, the Inland Empire Regional Chamber of Commerce, the County of San Bernardino, and a special thank today for Signfastic. This is one of our members of the chamber, and I'll be talking from their offices. Signfastic is the home of Clear World USA. So today we are going to be talking about an amazing subject. Every entrepreneur, every business owner, even every individual and household should understand the power of cash flow management. In fact, to give you a quick story about cash flow management with a twist, it started with practically a monthly conversation with the president of Chino Commercial Bank, which is really a community bank in the Inland Empire. And he was telling me that how a lot of the small businesses couldn't qualify for the PPP because they didn't have really grasp and command on their finances, having Schedule Cs, having their balance sheet income statement in order. So we decided that we want to create a series, some type of training for small businesses, and for all intents and purposes, for any size business to understand the power of cash flow. Just imagine if that small business understood the power of cash flow, they can withstand the ravages of the economic storms and economic disasters. So today we are going to be sharing with all of you, and the good news, it's being recorded, so it will become part of the Inland Empire Regional Chamber of Commerce database and content database, so to be able to refer to it in the future. So now, cash flow management, why do I say with a twist? Because I want to bring some different perspectives to cash flow management. Many times people think of cash flow, I sell, I expend money to produce a product, and I sell the product, and I collect my money. Is that what creates cash flow? That's only a little piece of the big puzzle of the big picture. We're going to be sharing with you the 7 C's. Since cash starts with a C, the word cash flow starts with a C, I thought to come up with 7 words that start with a C that will give us the strong foundation for cash flow management. It's the foundation that will lead us into the path to financial stability, security, and success. Now, when we think of business success and business and prosperity, many people think, oh, you just have to have business acumen. Notice how I designed the formula. It doesn't start with business acumen, because I can prove to you a lot of people who have extreme business acumen, that are geniuses in business, they might not succeed or stay in business for long. Because I can prove to you how many salespeople, they are great at sales when they work for a company, but when they start opening their own business, they sell, but they don't stay in business for long because they don't understand how to manage finances and financial issues. So in reality, business success is going to start with business financial planning and financial acumen. That is really where the foundation of success. Every business owner, before you think even to open a business, understand the power of finances and financial planning. Really hone your skills. If you are not able to hone your personal skill, have a team around you. Have someone on your team that understand financial planning and financial acumen. Now, when you add that to your business acumen and your business genius, then you add your personal strength, your personal finance and discipline. Notice business acumen is sandwiched between personal finance and discipline and business financial planning and acumen and discipline. Why? Because when you are a startup, no bank is going to give you money as a startup, because banks will say, I would like to see at least that you have been in business a minimum 1 year, 2 years, or sometimes 3 years before they will loan you some money or give you a credit line that is big enough to keep you going. That's why a lot of businesses start with through crowdfunding, money from friends and family, your own personal money, or some people they leave a company, they have a severance package, and they use that to open a business. Some even use their pension fund package, which is not a good idea, but some people will risk it all just for a business idea and to succeed. Today, I want to show you it's not about risking all. It's about taking calculated risks to succeed in business through ensuring your personal financial discipline and ensuring business cash flow that is timely. Now, before even we start, I want you to start thinking. This is really a moment of introspection. Consider this slide as if it's your X-ray machine, your MRI, your CAT scan. I want you to start thinking, what type of business are you? Are you a manufacturer? Are you a wholesaler? Are you a retailer or other? Specify. In reality, when you think about it, the type of business is going to dictate how much money you need, how much capital you need at the beginning of that business and throughout the business cycle. A manufacturer needs more capital than a wholesaler more than a retailer, and so forth. Now, understand that a business, then it can help you in understanding your cash flow. Then the second thing you want to ask yourself, what is your business model? Do you know your business model? That means first is you start saying, what business am I in? How do I generate revenue and my target profit? How does cash come in? Do you know the fundamentals of your business model? Are you burning cash before getting paid? A lot of people think if I'm in business, I can sell, therefore I'm successful. Selling doesn't mean that you are going to get paid for what you sell. There are many companies that are extremely successful at selling, but then that selling stays in their accounts receivable and it ages. And just imagine when the receivables age, you are not going to be able to collect it as fast. And the longer they take sitting in your accounts receivable, the less the probability of collecting that receivable. Maybe you'll collect it by sending it to third-party collection agencies, to attorneys. When you do that, you are sharing now not only your profit, but part of that investment in your receivable with that third-party collector or attorney. Do you know your cash burn rate? What is it? Can you reduce your burn rate? For example, if your sales efforts stopped, how much cash in the bank do you have today? And how many days it will keep you going before you close your doors? That's your cash burn rate. Practically, if I don't have any new sales, how much cash, how long can I exist? Which means it tells you the urgency of creating sales, profitable sales, and collectible sales. Do you know what is needed to double your sales? This is really fascinating. This is a question directly from the president of Chino Commercial Bank. He says, Eddy, do you know that a lot of people think just to double sales is easy? It's not as easy as it sounds. When I want to double my sales, that means, do I have the capacity to generate the numbers to double that sale? And if you haven't collected on your existing receivable, how can you get the money to get the raw material, to get the products in order to double your sales efforts? You might not even have that capacity to be able to double. So really doubling sales is not that easy. You have to have the other fundamentals there in order to move. Maybe you can, instead of doubling, and say, I can increase my sales by 10%, by 20%, by 50%, and then I can double it. So a lot of businesses don't think about that. They think, oh, good, I have a big purchase order. A case in point, when I used to work as a credit manager for a company, we had a distributor in Lima, Peru, and his monthly credit line was $30,000. And he landed $1 million transaction. Then he comes to me, Eddie, can you give me $1 million credit line? No, sir, I can't. At best, we can sell 360,000 because you take 30,000 times 12. But what about $1 million? That will take several years. With that, we had to find someone, the end user, who was extremely rich. He was able to go to his bank and get a loan for several millions to be able to sell that $1 million transaction. So really, when we think of doubling sales or increasing sales, we need to look at our own capacity, our own capital. We look at the income statement and also at the balance sheet. Do I have the net worth? Do I have the assets that can really collateralize a loan and so forth? The next question is, do you have cash reserves? Here is a challenge for everyone that is on the call and that will be listening in the future to this presentation. How many months can your reserves carry you? Do you have a plan to increase your cash reserves? If we just revisit the pandemic of 2020, 21, and even till today, thank God to the stimulus. Imagine if the government did not kick in stimulus packages, a lot of people would have really been in extreme financial collapse. A lot of business would have closed. But because of the stimulus, individual and businesses were able to stay in business, but not all of them. But just imagine if every business in the world, and especially in the United States, they had reserves to keep them going, not only for a year, but 2 or 3. That would be amazing. That's utopic. That's the utopia. But can it happen? I think every single business, every single individual, we should be putting ourselves in the path of building reserves to be able to say one day, yes, like in the past, they used to say, if you are an individual, you are employed, if you have 3 months of spending money, you're okay before you find a new job. Go back to 2008, 2009. I had a friend who was out of a job for 39 months. And this gentleman had a master's degree, even had all the certification that he could easily get another job. It took him 39 months to get a job. That's more than 3 years. Imagine if he went by the adage of having only 3 months reserves. That's not enough. He still needed 36 more months to stay viable and alive. So some people might say it's very difficult to have a 39 months reserve. I will say challenge yourself. Start with building 1 year reserves to keep you going if you lose your employment, if anything happens. And as a business, have reserves to keep you going without the need to go to your banker or to invoke governmental programs if there will be stimulus in the future. Just let's put ourselves on the pathway to reserves. Let's change our mindset from a spending mindset to building reserves and saving mindset. So this is a challenge. Can it be done? Some will do it, some won't. Do you have access to cash management tools and sources? Check all of that apply. That means as a business, do you have lines of credit with the bank? Look at yourself as an individual. You have credit cards. What is a credit card? Really, the limit on your credit card is a form of a line of credit. The bank that gave you that credit card told you, yeah, I can give you a card. This is 5,000 or 100 or 10,000. That's a line of credit. If you're in business, what about your terms with your suppliers? There's a big difference if you are in business and your vendors are giving you cash in advance. Then you have to pay the money before even you sell. Then you have to wait on your customers to pay you. But what if now the vendors like you so much and they said, I'll give you 15 days. Then you pay up and you perform, then they give you 30 days. And in some conditions, you can get 45, 60, or 90 days. That's huge. Terms with suppliers is a form of financing at zero cost to you. You don't pay interest, while with the bank, you're going to pay an interest. Do you have other reserves, other sources? Are you able to defer your payment without penalties or incurring more interest? Can you retire at that? So these are some of the tools that we need to think about if we are going to be engaged in cash flow management. This questionnaire is by no means all inclusive. This is just the tip of the iceberg. I just want you to really have this exercise in order to understand that cash flow management with a twist is comprehensive. It covers every angle, and you have to do it on a daily basis, weekly basis, monthly basis, semester basis, yearly basis, and so forth. You never stop managing your cash flow. Now, let me share with you this framework of the 7 C's. I want to show you that cash flow management is sandwiched between compliance and change. Just think about the pandemic. It introduced change, immediate change, quick change. And when you think about this word of change, not only individuals, but communities, states, and the whole world in one day had to lock down. And for several weeks, complete that. That's huge change. That was so sudden that no one in the world thought that this could happen at such a speed. Cash flow was affected because of that change. So I want you to always think about the word change. Nothing is constant in the world but change. Change is happening every second of the day. From the moment you came to listen to this presentation, I change, you change, everything has changed. But here are the 7 C's: compliance, contribution, consumption, conservation, cushion, compassion with community, and then change. Now, as I said, I can talk days on this subject. In fact, every C, we can talk a minimum an hour. It could be half a day, could be just on each of the C's. I'm going to spend more time on the first C of compliance because I believe it's really key to understanding cash flow and give you really a little taste of the other C's, because in 1 hour, I will not do it justice. We can do a whole day workshop on this one and still not do it justice. But I'm putting you on the journey to understanding these 7 C's and to really make your companies and every individual within your companies, if they pursue the path of the 7 C's, you are going to be very successful and even very prosperous. Because understanding the C's will help you not only to save money, but also to make money. Now, let's look at the word compliance. Notice here, there is a river. In fact, this is the Danube River. I took this picture when I was traveling in Europe on one of the rivers there, the Danube River. And think about it. I call it the river of cash flow. Cash flow management is like a river. It's flowing. It keeps flowing. But sometimes you come across a riverbed and you say there is no water. Cash flow could also evaporate. So that means sometimes you have no cash, and sometimes that river is going to be flowing with cash and overflowing. But one thing is very interesting. When you look at the banks of a river, it's really interesting word, banks. Banks, think about it, the banking system. That's where you put your money. You deposit your money. So really, if you look at the banks of a river, the water is that cash flow. You deposit that flowing river between bordered by these banks. So they're going really to regulate the flow and help you maintain and protect that cash. But look at the geodesic dome. That dome, this is really the C of compliance. Yes, even a river has to have borders, the banks. And when you have a business, your business has its own dome of protection. And that dome of protection is the boundaries, the rules and regulations, the acts that others are imposing on your business. That's why when we think of the word compliance, I want you to think of anything that is going to create a constraint, that is going to create a border, that is going to help you really understand measurements and control. Because when you have compliance, you have control. Someone is going to audit you. Someone is going to control your activities. But also let that one be your own company. You create your own OKRs, objective key results, your KPIs, key performance indicators, your own metrics, your own policies and procedures. So when you think of compliance, I want you to think of 2 parts, external and internal. The external compliance comes from the external environment. The internal compliance comes from your own policies, procedures, your vision and mission of the company. Now, just to whet your appetite, I just want to go over some of the things you have to think about when you are thinking of compliance and control. And in fact, it sets the stage to everything that could affect the business in a legal, reputational, business, economic, and financial ways. Now, here is a list that I'll be going over. Just mentally take note. You can write some, but remember this is going to be recorded so you can refer to it in the future. The first question you want to understand as to compliance: have you checked into compliance issues for your industry and company? Think about it. Any business belongs to a vertical, to an industry. Does the industry have specific guidelines, restrictions? Are there any governmental agencies that are going to regulate your business? Do you have all permits and licenses? Have you chosen the right business legal entity? Are you a sole proprietor? Are you going to be a partnership? Are you going to be a corporation? Is it a C Corp? Is it an S Corp? Are you going to be an LLC, etc., etc.? Do you have knowledge of all the laws and regulations that affect your business? Because remember, ignorance is not bliss. If we are ignorant concerning a law and regulation, we'll still be penalized. So here is a very interesting tip. If you are in business and you have a sales permit, if you sell and you collected tax, you have to report that in California to the formerly known as the Board of Equalization, the CDTFA, the California Department of Tax and Administration. What happens if you didn't sell during that reporting period? You said, I sold zero, therefore I don't have to report. Wrong. Failing to report triggers a penalty. The CDTFA will tell you, even if you didn't sell, you still have duty to report that zero sell. Why? Because you have a sales permit. They want to control every sales permit to make sure that you haven't sold without reporting those sales tax, because that revenue to the state. So you can see failure to even comply with the reporting requirement could trigger a penalty. That's why the IRS, as a business, you owe federal income tax. You have to duty to file and duty to pay. You can file without paying, it's okay. So it doesn't trigger the penalties of failure to file. But if you owe, you have to pay, and you pay with interest if they put you on an installment. Are you or will you be in full compliance with all local, state, federal regulatory bodies? So sometimes small businesses don't realize that there are rules and regulations before even I think to open my doors and start business. Remember, cash flow is affected. You want to get a permit, you might have to pay a fee for that permit. You need a license, there must be, right there, you are outflowing cash. You are not inflowing your cash, you're outflowing. So right there, even in starting a business, there is a series of outflows before you start getting inflows. For example, if you are a startup, do you have a business plan? Why? Because it should answer the what, the who, the when, the where, and why. A lot of people think, oh, a business plan, that has nothing to do with cash flow. It has everything to do with cash flow, because a business plan allows you to take away the blinders, not to have any blinders, no blind spots. Because remember, any blinder means later to fix costs money. Now, if you are an existing business, do you have a strategic plan? Again, it should answer the what, the who, the when, where, and why. Do you have periodic updates throughout the year on that strategic plan? Do you have a plan for every department in your company? Think about it. Strategic planning allows you to align and fine-tune. Just imagine, if you have to send a memo to every department and then you have to revisit that memo because of misalignment, time is money. You are spending resources. You're spending money without realizing it. But if everybody is on the same page, everybody understands the vision, mission of the company, every department is aligned with the overall mission vision of the company, then it saves you on that cash flow. There will be no misunderstandings. There will be no mistakes. So that's very powerful. So you could see even having a strategic plan saves you money. Here, another question. Have you established your values and standards? Think about it, standard of care, of high quality. That will save you money as a company. Imagine if, that's why I love the Toyota production system. The Japanese thought zero defect. In Kaizen, in Kanban, in process improvement, they aim to a zero defect. While American companies will say a 3% defect is all right. It's not all right. 3% defect is defect. It could cost a lot of money. It could really create ill will with customers, and you lose that goodwill and loyalty. But aiming for a zero defect also, there will be time and money expended to guarantee that zero defect. So some companies say, do I balance a zero defect with a 3%? And they do their analysis. But in my opinion, the long-term value proposition is better to have a zero defect rather than a 3%. So that comes also from understanding your values and standards. You have a clear vision for your company. It focuses you on the what and the why. Is the company vision infused into every department? Do the employees see the vision clearly? Is there a full alignment between company, department, and personal vision? Just imagine if everyone in the company misunderstood the vision and each one was working on getting to that final destination, taking different pathways and never converging. You spend time and money and never got to your destination. So that is very, very powerful. So this is just the tip of the iceberg. And I can tell you have pages of questions that I can talk about the word of compliance. Let me take, for example, a section of the balance sheet. Do you have the assets that help you generate sales and profit? If you sell products, how is your inventory level? Do you have current and saleable inventory? What is the rate of obsolescence? Is inventory secure? Are you maximizing shelf use? All that comes from your internal policies and procedures, and that falls within your compliance, from quality controls to inventory level management, etc., etc. So really, what I highly recommend to every business is to understand that if we are not compliant with rules and regulations, whether it's town, city, county, state, federal, we might be really losing money in the long run. If we are not in compliance with our own policies and procedures, vision, mission, we will be losing money in the long run. So that's the first C. Now let's go to the second C. Since the metaphor of the river, rivers don't form themselves. They have tributaries. That we, in a business sense, we have contributors. So what contributes to your cash flow river? Now, if you are a new business, you might say, okay, where do I get my cash from? I have my severance package. I have savings in the bank, have friends and family that they can pool the resources and come together and put their money and invest in my endeavor. Or I can find venture capitalists. That's why people go on Shark Tank. They approach angel investors, et cetera, because that's where the contributions come from. But that was when you are a startup. What happens when you are already in business? Look at the income statement and look at your balance sheets. Now, when I look at the income statement, what is the top line? It's sales revenue. Notice the word revenue. Revenue is a contributor to cash flow. It's not yet real cash because a sale is not a sale until the cash is in the bank. A sale that is not collected is not part of the cash flow river. But when you collect the sale and the money is in the bank, becomes part of your cash flow river. So really, every business needs to understand what are the sources of funds. What are the sources of my income? So now again, if I look at the top line, which is sales revenue, the source of that income are my customers. How do I get those customers? Sales and marketing. when a company engages in marketing efforts and sales efforts, now you are starting to generate the desire and the willingness to buy your product or service. So these prospects that become later converted into clients or customers become contributors to the cash flow of your company. It still is only the beginning point. You want that customer to be extremely happy. So when the terms are due, they pay you according to the terms of your invoice. And now you have cash in that river of cash flow. Who else contributes to your revenue? Many people just look at the immediate prospect, and they look at their incumbent customers. Have you thought to ask your customers for referrals? Referrals should be an avenue for more contribution into your cash flow. Maybe if you are a manufacturer, you are selling one type of product. Could it be that you can tweak that product and create 2 or 3 models, so each model becomes a revenue stream, a contributor to cash flow river? So this is, again, the tip of the iceberg. What I wanted to start thinking, and business owners, is how do I generate cash? Who is going to be contributing to my cash flow river? How can I succeed to keep that cash flow river flowing and healthy without drying or leaking? So that's very important. Find contributors that are going to be rich in their volume of purchases, goodwill, loyalty, that they keep flowing into your river of cash flow. Another thing that I want to think about, we can go more on this subject. If we look at the cash flow statement, really you have, for example, cash from operations, cash from investment activities, cash from financing activities. All this becomes part of looking at what contributes to your cash flow. But the cash flow statement also has uses of funds. If I have sources, I have uses. Again, if you have cruised along the banks of rivers, or you cruised in the river, you find out along the banks of rivers, take the Nile. The Nile, if you look at the map of Egypt, it's something unique. Yeah, Egypt, you have the Eastern Desert, you have the Western Desert. But then when you look from the delta down, you see the greenest part. The delta is very green and very fertile. And then you look, all the green is at the banks of the River Nile. So there are activities. People come to the Nile or come to a river for water, for bathing, for fishing, doing business. It's a highway. But also the lands around it, they have canals to take the water so they can have agricultural activities. And in some countries in Europe and in the United States, they use rivers because they have manufacturing facilities that require a lot of water. Which means that river of water is being consumed. Think of your cash. The same thing. That river of cash flow in your company is being spent. It's being consumed on projects, on initiatives, on buying raw material. And if you are a manufacturer, on producing the product, and so forth. So the funds that we get through the contribution phase is going to be consumed into the different operations. So what you need to do in this section, we will dissect really the income statement. I will dissect every line that is an expense. We start with the cost of goods sold. Are we really paying the right amount for the right product? Do we have the right vendor relationship? Are the vendors giving us the best terms and the best discounts? Are we really maximizing on the discounts with our vendors? Can we pay on time to get that extra 1 or 2%? Because sometimes they give you net 30, but they said 210 net 30. If you pay in 10 days, you get an extra 2%. That's huge. Annualize that. That's a lot of money. People don't realize. Take advantage of that 2%. Even as individuals, why do you like Citibank Visa with Costco? Because they give you money back. People use special tickets, for example, credit cards that gives them frequent flyers, frequent stairs. All that translates to money. So when you look at your income statement, you go line by line to realize, am I consuming my resources in a relevant way, in a good way? And is that expense needed? Because if you spend money on an expense that is not needed, is not generating revenue for you, there is no return on investment, you are wasting that precious resource called your fund. So you could see the C of consumption is going to help you to look at your financial position, at your income statement, and really make sure that any line that is in that income statement, if it's not relevant, it goes out, it gets eliminated. Also, I can go to the income, to the balance sheet now, because many times people say, oh, notice you have current assets, and then within current assets, you have prepaids. Sometimes people may be prepaid insurance. The question is, if you prepay the insurance, that's some money. They're not going to refund you in most cases. Then what happens? Did you buy the right rate of insurance? Or did you overbuy insurance? If you overbought, you paid money that you could have protected your cash flow. When you look also at your fixed assets, at buildings and land, are you having investment in buildings that are not productive? If you are a manufacturer, if you have a building that's doing nothing and not manufacturing, is that a good investment or a bad investment? So again, you use money to buy something, you got a loan, and now you are making this monthly payments that you could not even have entered into. Again, any item on your balance sheet, when it required capital expenditures, make the decision. Was it the right capital expenditures or not? Is it giving you return on investment or not? So when you think of uses of funds, I look at these both statements because they are going to be your map and your compass to realizing if an expense or an investment was right or wrong. Now let's look at the next C. That's the C of conservation. Conservation. This is an amazing concept in a financial sense. Let's start even with the individuals at home. You work hard and you receive a check at the end of the week or 2 weeks or the month. What do you do with that money? Do you squander it or do you conserve that money? Because if you don't conserve, what's going to happen? When you need that money, it's not there. That's why many times they say people who win the lottery, they lose it very quickly because easy come, easy go. They didn't work hard. They don't appreciate the value of that money. So conservation is going to tell you as an individual, and also as a business entity, as a company, every dollar you spend, make sure that it has conserved your cash flow and helps you to replenish. What do I mean by that? Imagine you want to buy a machine. If you just go and talk to the first dealer that can sell you the machine, you have really not conserved your resources. You could be ending up by paying more for that machine. But if you want a machine to conserve your resources, what you do is you look at multiple sources for that machine, multiple vendors or manufacturers for that machine. You do your comparative, you create a matrix, and then you look at the features, the benefits. You take the time to interview the different vendors. And then all of a sudden you realize the more you ask questions that maybe this machine, you don't need to buy it with all the bells and whistles. You can buy a machine B rather than A, and you would have saved tens of thousands of dollars or even more when it's a big manufacturing facility. That's a way of conserving your cash. Looking for discounts, looking for whether it's volume discounts or dollar value discounts, all of that. Like sometimes they say to a car dealership, if you sell 1 million car, after that, This is your discount for all the millionth cars that you bought. But if you sold 999,000, then it doesn't trigger. So then sell that million cars so you can get that discount on the whole million cars that you got. So conservation means you look at your river. Is it leaking? You look at your operations. Where am I hemorrhaging cash? Where are the leakages? Remember, time is money. Imagine if you had 10 employees in your department and each one clocked in 5 minutes late. To the company, what's 5 minutes? That's 50 minutes of production when you add the 10 employees. What about 100 employees or 1,000 employees? Now we are talking. So in essence, when we are conserving resources, we are going to be looking at leakages. We are going to be looking at, like, take a river, sources of pollution, sources that can create some toxicity in that cash flow river. So in essence, you look at your personal cash flow and your business cash flow. What are the areas that create toxicity in that river of cash flow? What is really sucking the cash from you? A good example, if you are a company, like I remember I worked for a company and we had a distributor in Chile. We called him the nibbler and the chiseler. Like first he will, when he started cash in advance, then he wanted 15 days and then 30 days and then 60-day terms. Then he wanted 90, 180. All of a sudden, longer terms is a form of losing resources because he didn't want to pay interest. So in essence, the present value of that account is less and less and less. The longer it takes, now I'm paying my bankers here for the loan that the company is getting to generate the revenues. So in essence, to conserve means to cut that chiseler and nibbler, to stop them from taking more terms. So again, look at your river of cash flow, look at your portfolio. Which customer is really bleeding you? Which customer is sucking the resources and the life out of your company? That's why some companies, without naming some, they call them eliminate the deadwoods. Whether your employees, they sad to say that companies to eliminate 10% of their employees by calling them deadwoods, but also the same concept applies to customers. Which customers are the high maintenance company end up becoming a liability for your company, and that's a form of leaking of your resources. Conserve by eliminating or rehabilitating that customer that is in your portfolio. So again, when we think of cash flow management, we are looking here at customer relations, at understanding how the customer behaves, how the customer pays you, and so forth. So really, when you think of cash flow management with a twist, it is not just think about I'm selling and I wait until I get paid. You have to look at the big picture. Where are my sources? How am I using it? Am I using it effectively and efficiently? Because conservation is about the 2 E's, efficiency and effectiveness. Are you being effective in every expense? Are you being effective in every activity that you are taking on to market your company, your product and services, to generate the leads, to convert the leads, and so forth? Because conservation is, again, here's another point. Don't look at the C's as linear. The C's are circular. Contribution, think also, how can I conserve what has been contributed? Consumption, how I conserve what I'm consuming. So you see, I wanted to think in terms of really that they're all intertwined. Don't think linear. We are taking them as topical right now, but when you do it in a pragmatic way, you're going to be thinking about conservation and consumption all at the same time with contribution and compliance. So really, it's about a chaotic approach to cash management, but it's not chaotic because it's the universe coming together to make sure that that cash flow river is not going to be depleted, is not going to be attrition, is not going to be polluted. The next thing, imagine if you have done correctly in your contribution and consumption and conservation, and you are compliant, so there will be no penalties, no bleeding from regulatory agencies and so forth, then it stands to reason you are going to have a cushion. In fact, If you have, sometimes when you cruise on rivers, you come across dams. All of a sudden, say, wow, all the water is being collected for future use or for protecting the area from inundation, from over volume, or losing that cash flow. So the same thing with the company. If you are selling and you are selling profitably and you are converting your high quality receivable into cash, what are you doing with the cash? Are you building a cushion in the lake of tranquility, financial stability, and security, or you are squandering the cash? A case in point, many years ago, when I was working for a company, I came across a distributor in Mexico. And he said, Eddie, I would like you to give me $500,000 line of credit. I said, sorry, I can only give you 10,000, not 500,000. But he says, Eddie, I'm very successful. I said, I understand. But when I analyze your financial statements, I cannot give you a line based on my financial analysis. So I flew to Mexico, met with them, and I said, okay, tell me, what is happening? I found out that they're extremely profitable, but at the end of the year, what they do, they take the excess cash, the excess profit, and they buy land with it. They love ranches, haciendas. But that goes under their personal wealth, not the company standing. So when analyzing the books of the financial statements of the company, I always look at the net worth, the tangible net worth, and there's a formula. You can give them anywhere from 10 to 40% of the tangible net worth. So when their net worth is a negative because they're taking all the cash, you give them zero. But it doesn't mean that they are not profitable, or the return earning could be 10,000. 10% of that is just nothing, is 1,000. He wants 500,000. When he started reinvesting in his company and beefing up the return earning, this customer over a number of years was able to move from a 10,000 credit limit to 700,000 credit limit. That's huge. Another one was able to move from a 50,000 to 300,000, but it took some years, some work reinvesting in the company. So really, as a company, and even as an individual, here's a personal challenge for anyone who listens to this presentation is, can you take 25% of every dollar you make from your employment and put it aside in a savings account and forget about it? It's very hard, but what happens after a year or two if you consistently took 25 cents of every dollar you make after taxes and don't touch it? Now you're building a cushion for financial stability and security. Some might be able to do that, some might not. But if we take this concept to even kindergartners and go on through life from kindergarten to until you graduate from high school, college, and even take it into the business community, everyone should start building a lake of tranquility, financial stability, and security by building a cushion. I think things will be better in the future. What else we need to understand? Many people just think of the first C's or they stop at the fifth C. But I want to inject another C that even 2020, the pandemic, has brought to our attention. It's the C of compassion with community. Think about it. Thanks to the iGen and Generation Z, they are now requiring companies to invest back in their community, to invest back into their operations and their employees. But before we look inward, we need always to look outward, because companies are taking resources from the external environment. So are we giving back to the community? Are we investing in our communities? Just think about it. If trucking companies keep on moving on these asphalted roads without maintaining those roads, what happens? It becomes difficult for them to be traveling, and then for us private citizens to be traveling on those roads. And also it will affect their mileage, will affect if they want to be on time at a certain place. When the highway is very smooth, they're going to be faster, there will be fuel efficiencies, less maintenance, etc. But can you imagine if now, as too many trucks use the road and these trucking companies and communities don't reinvest in the road, what happens? Something will go wrong with their tires, with their axles. if they are carrying like precious cargo, and if it needs to be on even surface and so forth, it could affect their load, etc., etc. It could also affect their way of driving, and it could cause accidents. Wow. When everybody invests in the community, so to speak, in the river of cash flow, we maintain it spick and span, unpolluted, in pristine conditions. We put back what we took out of that river. So anytime you take part of your cash flow river, you put back into that cash flow river. And when you give back to the community, what happens? It's a form of PR, public relations. It's about advertising. It's about marketing. It's about building your reputation and your brand, that you are a company that cares. What happens now to your income statement, to the top line, which is called the revenue line, sales revenue? It increases. People want to buy from companies that care. And that's exactly what happened during the pandemic. From 2020 onward, people are supporting companies that care. And they are requiring companies that don't care to change their ways of thinking. Because that's the trend. That's what I hear from around the world. The different smart briefs that I'm reading say that we need to care about our communities. And companies do that by giving back and investing in that community. In fact, individually, we are one drop. Together, we are an ocean. And I love this imagery. So imagine if every person in the company and every company gave back to the communities. Now there will be an ocean of goodness and there will be goodwill. And that would translate into more sales. More sales with goodwill and loyalty, more profit. More profit means more cash for that company. So the we of compassion, understanding the we, not just the me, the company, the we, the community, will make us far more wealthier and more really compassionate towards all. But that's not the end. There is a seventh C that we need to understand. Remember, 5 C's are sandwiched between compliance and change. The C of change is the only constant. It will keep changing. Things will change. Tomorrow will be different than today. Next week will be different than this week. Next month will be different than this month. We have to be up to date with what is happening in the environment, what is happening in our own internal environment, understanding our employees, their visions and mission. That's why here is the key. Some companies are investing in their communities, but they're forgetting a key component. The most important person in that company is the employee. Are we investing in ourselves, in our staff, in our employees, in our businesses? Because think about it, if a company keeps on giving without getting, and if the company helps the outside but not the inside, we are not going to be as successful as a company. So the C of change reminds us that change means growth. Are we growing ourselves internally? Are we growing every employee? How do we grow employees? Maybe by creating matrices of training, sending employees to conferences, help them to be members of association, of different clubs where they can learn and they can grow, because learning leads to growth. So are they learning new skills? Are they upskilling? Are they really upgrading their skills? All of that is very important for cash flow management. Because think about it, a highly skilled individual and a highly skilled department leads to a highly skilled company and a far more profitable company. So that's where, when we bring all the 7 C's together, we can understand we cannot have any blinders. If one C is missing, the cash flow river, our cash flow of the company is going to be affected. So this is the challenge for all of us. We need to understand that cash flow management with a twist includes all 7 C's. Make sure that none of them is missing. If we do that, look at this screen, there is a butterfly. But before it's a butterfly, it was a caterpillar. That through the process of transformation, it became a butterfly that can you yourself and others enjoy it. But as it hovers, it can see the beauty of your cash flow management. And it came from understanding the 7 C's of cash flow management with a twist. And with that, I come to the end of this presentation. I want to thank the Inland Empire Regional Chamber of Commerce for this opportunity, the San Bernardino County Economic Development Department. And feel free to refer to this into the future. And let's build a strong cash flow river together. Thank you very much. Back to you, Mr. Ornelas.